Previously on Dry Powder, Jean-Remy Roussel, a managing partner at CVC, made a clear, compelling case for an ESG strategy that spans the portfolio.
The environment, if it continues to change, can have a massive disruptive impact to the sustainability of your company.
But how do you ensure follow-through within a portfolio company, from the C-suite to the front line?
You don't go home motivated by EBITDA or cash flow. No one is motivated by this.
Today on the show, I'll ask Jean-Remy Roussel how he makes ESG fully operational. He'll explain how consistent follow-through has enabled CVC to turn a sagging company into a high-performing machine.
You go home and tell your family about how proud you are to make the best product or a better product that you did and better than competition. That's what makes you proud.
I'm Hugh MacArthur, head of Bain's Global Private Equity Practice, and this is Dry Powder. So it really sounds like these ESG topics, for some it can be kind of a box-ticking exercise, kind of do no evil, but this is really embedded as part of a core part of your entire value creation plan. It is really the value creation strategy of CVC. Is that fair to say?
It is fair to say that, because we've seen that by working on those inputs and not the output, which is the financial performance, is a real review of what you've started to do 18 months, 24 months, 6 months, 3 months ago. And if you work on the right indicators, right insights, yes, you will be creating what we say, creating better businesses. And you do that through sustainable value creation plan, absolutely.
Can you walk us through an example of how you actually executed one of these ESG strategies at a newly acquired company starting kind of day one?
So to give you an example, we acquired 6 years ago a company in the consumer goods food sector. It was in 3 geographies, France, Germany, and Nordics. They were losing share in France for 8 years and 5 years losing share in Germany. And the brand was losing money. And so we bought this business at a little bit more than 7 times earnings. And we sold it at 11.5 times, precisely because we showed exactly what I said earlier: engagement of people, quality of product, market share, and so on. So when we went in and we visited the plant, and then we had a meeting with R&D, and we sat down with R&D and marketing and sales. And we said, what do you think about this product? So they looked at me saying, what should we say? And I said, tell me what you think. R&D lady said, I'm not buying these and feeding my children with it. I said, why? He said, look at the black spots here in potatoes. Meatballs supposed to have 6, there's often 4 or 5, and so on and so on and so on. I said, okay, why don't you come back with what you think should be done to have the best product in the market? And they could not believe. And they say, yeah, but what does it mean for cost and how we constrain and so on? Anyway, long story short, they came out with the right product. 2 years later, the company started to gain market share again, advertise again. So when the employees saw on air the brand with advertising campaigns, they are cheering, and the company grew market share. We have invested 10 million euros in the plant to modernize, because some of the issues was sourcing of product, so cost, and some of the issues was process capacity and process quality. So we've redone the factory. We hired apprentices. We restarted because they thought we're going to cancel everything because we're PE. So the engagement of people went up. We reduced impact on the environment because we decreased the water, we decreased the acid for cleaning through new processes, we decreased the energy consumption, we improved the sourcing with much more local, shorter freight, higher quality. We've done a complete ESG, but without telling them. And the result was growth in market share.
Sometimes they're doing the right things and they don't even realize they're doing the right things. They're just seeing the value in being created by the plan that you're putting in front of them and the questions that you're asking to fundamentally improve the product so that the employees would be proud to serve it to their family, as well as obviously enticing customers.
You'd be amazed how many times when you walk around Salesforce or R&D or production, they know. I was in a pet food plant and they're losing market share, and I spoke to R&D, and one person had tears in their eyes and said, I'm not feeding my dogs with this product anymore for the last 5 years. I'm ashamed of working here. So when you say, okay, you have carte blanche to come back with a recipe you think you'd be proud of, and we can start winning market share again, guess what? The motivation goes up. And if you really do it and you start gaining traction and market share, the amazing engagement level of the people, You don't talk EBITDA. Nobody's motivated by doubling the EBITDA or the percentage or the cash flow. No one is motivated by this. You don't go home motivated by EBITDA or cash flow. You go home and tell your family about how proud you are to make the best product or a better product that you did and better than competition. That's what makes you proud. Not EBITDA or cash. Maybe the CEO, and not even that, actually. In the end, yes, but not on a journey.
You know, Jean-Remy, it really seems counter to what you read about in private equity, where speed to increase EBITDA is everything because either multiples are high, or in the example you just gave, you know, the people were fearing that the business is going to go bankrupt. And so the impulse can be, we have to move fast, we have to do things incredibly quickly. And what you're describing feels much more like a very patient approach. It might take a couple of years, but if we do the right things, we actually have conviction that the right outcomes will be there. Am I getting that right, firstly? And then secondly, are there things that you do at speed because you're still paying high multiples or you're concerned about bankruptcy to help shore things up while you're actually implementing the type of value creation and ESG approach that you just outlined?
So 2 parts of your question. The first part, I do think that we have an advantage over corporate because we have 5 to 7 years to do the right thing. And we will get the value creation and the exit value, not by next quarter's EBITDA and cash. And therefore, in CVC, but I see also when I speak to some other colleagues of Upstream, the focus for good, serious funds, they will think, what do we need to do to transform this company? If you think about the environmental challenge, the digital technology challenge, you can't do like this overnight. It takes time. But we can. You can say in a business plan for 2 years, we'll go down, and then we'll go back up. As long as you have the KPIs to track that you're doing the right things and the lead indicator on customer insights, satisfaction, awareness, consideration, you know this is a good lead indicator. Same with employee engagement. So if you do the right thing, you know it's going to pay off. And so many times we carve companies out of corporate, and they basically tell you that their CapEx budget, the Salesforce budget has been cut, R&D, innovation has been cut centrally for 2 years because priority is given to something else. And all of a sudden you give them means to start fighting their own battles locally. So I do think that PE has an advantage over corporate for that. You may find, I'm sure, the counter example, I'm sure we have in CVC where we had to take short-term measures because we bought too high, cycle turned, and if you pay too much and you didn't see disruption in the industry, it's very difficult, and you sometimes have to, cut costs to refloat and avoid covenants and so on. But by my majority, when you look at the home runs or the good returns that is being made in PE, companies have been transformed. They've really been changed for better because the exit multiple is so important, so important.
And given how important these ESG topics are becoming to institutional investors and LPs of all kinds, do you find this useful in telling the fundraising story as well?
Yes. We just raised Fund 8, which is a 22.2 billion in the middle of COVID. So we closed in June. And for the first time, we had at least 1/5 of our investors had dedicated ESG audit, asking them not like in previous fund, what do you think of ESG and how are you thinking about doing it? But can you show me evidence that it is part of your decision making? Can you show me evidence that you are screening on due diligence? Can you show me evidence that you're working with the company on ESG issues? And so some companies in the Nordics have been there for 10 years and very big on environment and then on social. In the US, the social aspect has been increasing in the last years, but also the environment is picking up. As you've seen some disasters, ecological disasters, people are wondering, if you've got your plants in the wrong place and it's flooded and, how do you think? Investors say, okay, you buy a company, maybe 5 out of 7 plants are in the wrong place, and you're going to sell it in 7 years, and then the seller will do an audit. And if the audit is that 5 out of your 7 plants are going to go under flood, you're not going to get anybody to buy, you're not going to get anybody to lend money, and you're going to have a serious issue. That's what I'm talking about, the digital disruption, the environment disruption. So it has become a real topic for our investors, and we would not have been able to raise money if we do not have evidence that we are deploying ESG in our investments and at CVC. And we've made one step further, we've asked EcoVadis, which is an independent rating agency, to rate CVC as a firm. So this year we've received our first EcoVadis rating, in the same way as the NPS and the engagement. And we're rating all of our 80 portfolio companies. We have 35 so far, and we started earlier this year. And the aim is by 2021 to have all of our portfolio companies. And of course, then is to improve over time. So you have scores, bronze, silver, gold, and you have sort of outstanding platinum. And we want to make sure that we show pragmatically and factually with an external validation that ESG is improving the focus of management and is improving over time in our companies. So we'll be able to demonstrate this in the same way that you'd have a financial audit of your financial performance.
It makes a lot of sense. I mean, it's one thing to talk the talk, but you're really walking the walk with evidence-based success, utilizing your ESG strategy to improve the value of not only all of your portfolio companies, but of CVC itself.
It's important for us to do it also and to improve.
On the next episode of Dry Powder.
An ESG strategy doesn't look any different from any other strategy. So you need a clear ambition, 2 or 3 issues where I'm really going to put the bulk of the effort. And then it's the key metrics.
Jenny Davis-Picou explains how she helps clients find their way through the forest of ESG indicators.